What if the next financial crisis isn't something that will happen, but something that has already begun? Not with a dramatic stock market crash, not with headlines screaming panic, but quietly, almost invisibly, building underneath the surface of the global economy. Because if you're waiting for a single breaking news moment to tell you the crisis has started, you might already be too late. Right now, markets still look stable. Governments say everything is under control. Banks appear strong. But beneath that calm surface, the same patterns that triggered past financial collapses are reappearing almost perfectly. And this time they may be even more dangerous. But to understand why, we need to go back. Not to 2008, but to what caused it. Because financial crises don't start with crashes. They start with decisions. At the core of every financial system is one simple idea: confidence. People trust banks with their money. Investors trust markets. Governments trust that growth will continue. And as long as that trust holds, the system works. But history shows something important. Every time confidence grows too strong, it turns into overconfidence. Before 2008, banks believed housing prices could never fall. Before the dot-com crash, investors believed internet companies would grow forever. And each time, that belief created a bubble. A bubble fueled by cheap money. After every crisis, central banks step in to fix the system. They lower interest rates, they print money, they inject liquidity. After 2008, central banks around the world slashed interest rates to near zero. They created trillions of dollars. This flooded the system with cheap money. And cheap money changes behavior. Borrowing becomes easier. Risk-taking increases. Asset prices rise. At first, it looks like recovery, but in reality, it's something else. It's the beginning of the next cycle. Years of ultra-low interest rates didn't just stabilize the economy, they distorted it. Companies began borrowing not to grow, but to survive. Governments accumulated massive debt. Investors chased higher returns and riskier assets, and slowly, a dangerous structure began to form. But that condition doesn't last forever. Then came the turning point: inflation. Central banks faced a new problem. To fight inflation, they had to raise interest rates. And that's when the real pressure started. But rising interest rates are like gravity returning to a system that forgot it existed. Suddenly, debt becomes expensive. Companies struggle. Governments face higher interest payments. Consumers cut spending. But here's the key detail most people miss. The system isn't built for high interest rates anymore. Then comes the breaking point. But unlike past crises, this one may not begin with a single event. A major bank facing liquidity issues. A government struggling with debt, a corporate default. Each alone might not cause a crisis, but together, they can, because financial systems are interconnected, and when one part fails, it spreads. Now we reach the fallout. But here's what makes this potential crisis different. In previous crises, central banks had room to respond. But this time, their options are limited. They're trapped. Markets don't just react to events, they react to uncertainty. When investors don't know what central banks will do, confidence starts to fade, and once confidence begins to break, it doesn't come back easily. The failed fixes, because the same tools used to solve past crises may no longer work. Each solution becomes part of the next problem. Right now, global debt is at historic highs. Interest rates are rising faster than they have in decades. Housing markets are slowing. These are not isolated events. They are patterns. The same patterns seen before every major financial crisis. This time, the signals are more subtle. Instead of one massive bubble, we have multiple smaller ones. A crisis that doesn't explode, but spreads. It means the next financial crisis may not arrive like a storm. It may feel more like a shift. A gradual tightening, a slow erosion of confidence. And by the time it becomes obvious, it's already fully underway. First, financial crises are predictable in pattern. They begin with cheap money, rising risk, and overconfidence. Those conditions are already here. Second, the real danger isn't the crash, it's the buildup. The warning signs appear long before, but most people ignore them. Third, this crisis may be a slow, complex chain reaction, one that moves across sectors and markets, making it harder to detect and stop. The real question isn't whether a financial crisis is coming, it's whether we're already in it. Because history doesn't repeat exactly, but it rhymes. And right now, the rhyme is getting louder. Stay ahead of the story. Because by the time everyone sees it, it's already too late.